Ever find yourself second-guessing your investment decisions? Like maybe your gut feeling isn't always the best financial advisor.
It's a common dilemma. Emotions can definitely cloud our judgment, especially when it comes to money.
Exactly. So today we're taking a deep dive into a tool that can help bring some logic back into the equation: stop-loss orders.
Stop loss orders, it's like setting up a safety net for your investments.
Exactly. It's like saying, if this stock drops to this price, I'm out. Taking the emotion out of those tough sell decisions.
And that's precisely what we'll be unpacking today. Using some insights from Investopedia, we'll cover how these orders work, why they can be so valuable.
We'll even touch on some more, well, shall we say, advanced tactics for those who want to take it to the next level.
The beauty of stop loss orders is their simplicity. Essentially, you're setting a predetermined exit point for each of your investments.
Right, like if this stock hits this price, sell automatically. And what I find really fascinating is how Investopedia describes it. They call it a free insurance policy for your portfolio.
I like that analogy. You're getting downside protection without having to pay a premium.
Exactly.
Yeah.
Unlike, say, options contracts.
Right, where you pay for the right to buy or sell at a certain price.
Options are a whole other deep dive waiting to happen.
Definitely.
But for today, let's stick with the elegance of stop-loss orders. They're easier to grasp, especially if you're newer to investing. So let's make this concrete. The Investopedia article gives a great example using Microsoft. Let's say you buy Microsoft shares at $20 each, feeling optimistic about their future. But you also want to manage your risk.
Right, you don't want to leave it all to chance.
Exactly. So you set a stop-loss order, let's say at $18.
Okay.
This means that if Microsoft dips down to $18 or below, your broker automatically sells your shares at the current market price, limiting your potential losses.
Now, it's important to remember, a stop-loss order turns into a market order once that price is hit.
Which means,
Meaning, you're not guaranteed to sell at that exact $18. Especially in a volatile market, things move fast.
so it's like, get me out at this price, or as close to it as possible.
Precisely. And that's where the stop limit order comes into play, gives you a bit more control. With a stop limit, you set two prices. The stop price, that activates the order, and then a limit price.
And that limit price is?
That's your absolute floor, the lowest you're willing to sell.
So it's like a stop loss with an extra layer of like, nope, no lower.
Exactly. But of course, like most things in investing, there's a potential trade-off.
There always is. Nothing's ever easy, is it?
Yeah.
So what's the catch with a stop limit?
Well, while that stop limit guarantees you won't sell below your limit, it also means there's a chance the order might not be filled instantly. Especially if the market's moving rapidly and doesn't reach your limit, you might miss out.
So it's a balancing act then.
Exactly. Between that ironclad control over your sell price and the risk of missing a potential rebound.
So we've covered the what stop-loss orders and the how those stop and limit prices. But what about the why? Why would someone actually use these?
Now we're getting to the heart of it. The beauty of these orders is, well, how adaptable they are. You can tailor them to your investing style, whether you're, in it for the long haul or playing the short game.
Okay, so different strokes for different folks. Give me an example.
Let's say you're a short-term trader, right?
Yeah.
You're all about those quick price swings.
Buy low, sell high, quick turnaround.
Exactly. You might set really tight stop losses, maybe 5%, even less. You're prioritizing that quick exit over potentially bigger gains if things start to go south.
Makes sense. You're not emotionally attached to the stock. You're there to make a profit fast.
Exactly. Now, on the flip side, picture a long-term investor, someone who really believes in a company.
They're in it for the long haul, right out the bumps in the road kind of investor.
Exactly. They might set a wider stop loss, like 15% or more, giving that stock some breathing room. They're not going to panic over a little dip.
Makes sense. They're looking at the bigger picture, those long-term gains. But that brings me to another thing you mentioned earlier, the psychological aspect.
Oh, absolutely. Taking emotions out of investing. Huge.
It's so easy to get caught up in the moment, right? You see your stock plummeting and you hit that sell button out of pure panic.
It's human nature.
And then what happens? It bounces right back and you're kicking yourself.
Happens all the time. That's where these stop losses, they act like, well, a pre-commitment device.
You're saying it takes the emotion out of selling.
Exactly. You're not second-guessing yourself in the heat of the moment.
Because you already made the decision when you were thinking clearly.
Exactly. And that psychological benefit, that peace of mind, can be as valuable as any potential losses you avoid.
That makes a lot of sense. You know, it's funny you keep saying safety net. It's like you're protecting your downside. But what if you could use a similar strategy to lock in profits as a stock goes up?
Now you're talking about something called a trailing stop.
A trailing stop, that's a new one.
It adds a really interesting dynamic element to the whole stop loss thing.
I'm intrigued. Tell me more.
So remember our Microsoft example. Instead of a fixed stop loss at $18, imagine setting a trailing stop, let's say 10%.
Okay, 10%. I'm following.
As Microsoft goes up, your trailing stop rises with it, always maintaining that 10% buffer below the stock's highest recent price.
So if Microsoft goes up to, say, $30.
Your trailing stop would automatically adjust to $27.
Wow. So even if it suddenly drops, you're still locking in most of your gains.
Exactly. Your safety net moves up with the stock price. You ride that wave of growth, but with a safety cushion.
That's brilliant. It takes the guesswork out of knowing when to sell.
Especially when a stock's doing well, it's tempting to hold on thinking it'll go even higher.
Greed is a powerful drug.
Isn't it? Trailing stops help you manage that greed, lock in profits while letting the winners run.
So it's not just about preventing losses, it's about maximizing those gains too.
Yeah, exactly.
Okay, I'm seeing the appeal here. But like any strategy, I'm guessing there are downsides.
There are always caveats, right? And we'll dive into those right after the break.
All right, so we're back, and I think it's time to address the elephant in the room. Because as much as we'd love a foolproof strategy, there's always a flip side, right?
Right. It's about having a balanced view, understanding both the pros and the cons.
Exactly. So with stop-loss orders, what are the potential downsides? What should people be aware of?
Well, let's talk about those short-term fluctuations.
The ups and downs that inevitably come with the market.
Exactly. Imagine you've set your stop loss and it gets triggered by, say, a sudden dip.
Okay, following.
But here's the thing that dip. Turns out it was just a blip. The market rebounds quickly and you sold prematurely.
Oof, I felt that pain. It's like the minute you sell, the stock takes off without you.
It's a common scenario, and it really underscores the importance of setting those stop loss levels carefully.
Because set them too tight, and you're basically guaranteeing you'll miss out on potential gains.
Right. It's about finding that balance, protection, but also patience.
Right, knowing your stock and how much it tends to jump around.
Exactly. Research is key. You need to understand how volatile a stock is, how much it tends to swing, even on a good day.
Yeah, those normal ups and downs. It's part of the game.
Exactly. And speaking of the game, there's another risk factor to consider. It's called gap risk.
Okay, gap risk. Sounds intimidating. Break it down for me.
Remember how we talked about stop-loss orders turning into market orders when that price hits?
Yeah, sell at this price or as close as possible kind of thing.
Exactly. But here's the thing. In a fast-moving market, prices don't always move in a predictable way. They can gap, meaning there might be a big difference between the price that triggered your stop loss and the actual price at which your shares are sold.
So even with a stop loss, you could still end up with a bigger loss than you planned for if things move really quickly.
It's a possibility, especially with more volatile stocks or those less frequently traded. Those price gaps can be, well, larger.
So it's not a foolproof system.
Exactly. Stop losses are more like, shock absorbers.
Okay, I like that. They cushion the blow, but they don't completely eliminate risk.
Precisely.
This has been super insightful, but let's get practical. If someone's thinking, okay, stop loss orders, I'm interested. Where do they even start? How do you decide what percentage to set?
It always begins with you, your risk tolerance.
How much am I comfortable potentially losing?
Exactly. Once you have that clear, then you factor in things like the stock's history, how much it swings, any patterns you notice in its price.
So it's a bit of art and science.
Absolutely. There's no one-size-fits-all formula. It's about gathering the information, but also trusting your gut, finding that sweet spot between protection and giving your investments space to grow.
And I imagine it's not a set it and forget it kind of deal, right? You have to stay engaged.
Absolutely. As the market changes, as your own investment strategy evolves, you might need to adjust those stop-loss levels. It's about staying flexible, adaptable.
I like that. So in the end, stop-loss orders are a tool, a really helpful one, but not a guaranteed win.
Exactly. They're one piece of a much larger puzzle.
And the decision to use them or not really boils down to, like you said, your personal situation, how much risk you can handle, what your goals are.
Couldn't have said it better myself.
This has been an awesome deep dive into stop-loss orders.
Yeah.
But now it's your turn, listeners. Have you used stop-loss orders in your own investing? What strategies have you found helpful? We'd love to hear your thoughts. Head over to our social media and let's keep this conversation going. Until next time, happy investing, everyone.